Stop researching stocks this way. Most investors check the price, read a headline, and lose money. 7 steps separate winners from losers. Here they are. Before we dive into the 7 steps, let me tell you why this matters more than ever. In 2024, retail investors lost over $400 billion in the stock market. $400 billion. And the crazy part? Most of those losses were completely preventable. They happened because people skipped the research that actually matters. They bought stocks based on social media hype, random tips from coworkers, or worse, they just picked companies with names they recognized. But here is what nobody tells you. The professionals who consistently beat the market? They follow a specific research framework every single time. No exceptions. And by the end of this video, you will know exactly what that framework is. But first, you need to understand why most stock research is fundamentally broken. Step 1 is where most investors fail immediately. Understand the business model. Sounds simple, right? But here is where it gets interesting. Warren Buffett famously says he only invests in businesses he understands. And most people think they understand a company just because they use its products. That is a dangerous mistake. Understanding a business means knowing exactly how it makes money. Not just what it sells, but who pays, how often they pay, and why they keep paying. Take Netflix for example. Most people would say they sell streaming subscriptions. But the real business model is content licensing, an original production that creates subscriber retention. See the difference? If you cannot explain a company's revenue streams in 3 sentences, you do not understand it well enough to invest. And this is where it gets truly disturbing for most portfolios. But here is the thing. Understanding the business is just the beginning. Step 2 is where the real separation happens. Analyze the financial statements. And I do not mean glancing at revenue growth. I mean actually reading the 10K filing. The income statement tells you if a company is profitable. The balance sheet tells you if it can survive a crisis. And the cash flow statement? That is the one Wall Street watches closest. Because earnings can be manipulated, but cash flow cannot lie. Here is what most investors miss. A company can report record profits while burning through cash. That is a massive red flag. Look for free cash flow. That is operating cash flow minus capital expenditures. If free cash flow is consistently negative while profits look great, something is very wrong. The data shows something surprising about companies with this exact pattern. Step 3 is the competitive moat analysis. This is straight from Warren Buffett's playbook. A moat is what protects a company from competitors. Think about it like a medieval castle. The wider the moat, the harder it is for enemies to attack. In business, moats come in 5 forms. Brand power like Apple or Coca-Cola. Network effects like Facebook or Visa. Cost advantages like Walmart or Costco. Switching costs like Microsoft or Adobe. And regulatory barriers like utilities or pharmaceuticals. Here is the critical question. Does this company have a moat that will exist in 10 years? Because a company without a moat is a company that will eventually get destroyed by competition. And the math does not lie about what happens to moatless companies. But the real opportunity is this. Finding wide moat companies trading at fair prices is how generational wealth gets built. Now here is where everything I just told you comes together. Step 4 is valuation analysis. And this is where most investors get completely destroyed. Because a great company at the wrong price is a terrible investment. Let me put this in perspective. If you bought Microsoft in 1999 at the peak of the dot-com bubble, it took you 16 years just to break even. 16 years holding one of the greatest companies ever created. That is the power of valuation. Forget price to earnings ratio. The metric that matters most is price to free cash flow. It tells you what you are actually paying for the cash a business generates. And this is how you profit from it. When price to free cash flow drops below 15 for a quality company, that is when professional investors start accumulating. But wait, there is more to this story that changes everything. Step 5 is insider trading analysis. And no, I am not talking about illegal activity. I am talking about legal insider transactions that are publicly reported. When executives buy their own company stock with their own money, that is one of the most bullish signals in investing. Think about it. These people know everything about their company. They see the internal numbers, the upcoming products, the real challenges. And when they put their personal wealth on the line, that tells you something. The math does not lie about this pattern. Companies with significant insider buying outperform the market by an average of 7% annually. But here is the flip side. Massive insider selling, especially from multiple executives at once, that is often a warning sign of trouble ahead. You can find this data for free on sec.gov. Every insider transaction is reported within 2 business days. What the wealthy do instead is check this data before every single investment. Step 6 is institutional money flow. This is where you follow the smart money. Hedge funds, mutual funds, pension funds, they manage trillions of dollars. And they are required to report their holdings every quarter in 13F filings. Here is why this matters. When multiple top-performing institutions start building positions in the same stock, that is a powerful signal. These are not retail traders making emotional decisions. These are teams of analysts with resources you, and I will, never have. But here is the twist most people miss. You do not want to copy their trades exactly. By the time 13F filings are public, the information is 45 days old. Instead, look for trends. Is institutional ownership increasing or decreasing over multiple quarters? Are the best performing funds adding or trimming? This is how professional investors get an edge without insider information. And step 7? This is the one that ties everything together and separates good investors from great ones. Step 7 is catalyst identification. This is the timing element that most investors completely ignore. You can find a great business with solid financials, a wide moat, fair valuation, insider buying, and institutional accumulation. But if there is no catalyst, the stock might sit flat for years. A catalyst is an upcoming event that could unlock value. Earnings reports, product launches, regulatory approvals, management changes, industry shifts, macroeconomic factors. The key question is what will make other investors notice this stock in the next 12 months. Because in the stock market, Being right is not enough. You need others to eventually agree with you. And when all 7 steps align, business model understood, financials solid, moat established, valuation attractive, insiders buying, institutions accumulating, and a clear catalyst ahead. That is when you have found a high conviction investment opportunity. That is the framework Wall Street uses. And now you know it too. Now you have the exact 7-step research framework that Wall Street professionals use. Business model, financial statements, competitive moat, valuation, insider activity, institutional flow, and catalyst identification. Most retail investors will never take the time to learn this. But you just did. That already puts you ahead of 90% of the market. If this changed how you think about stock research, subscribe to Unbanked Minds for more wealth building strategies the financial industry does not want you to know. And tell me in the comments, which of these 7 steps were you missing from your research process? I read every single comment.